All right, let's dive into a real puzzle at the heart of global finance. We're going to talk about why some of the biggest, most powerful multinational companies on the planet sometimes end up paying more for their money than a tiny local competitor. It's a high-stakes, confusing journey, so let's try to navigate this multinational money maze together.
So this is the central paradox we're digging into. I mean, think about it. It feels completely backward, right? A massive corporation with a presence everywhere, with access to capital from New York to Tokyo, you'd think they'd have every single financial advantage. But the reality? Well, it's a lot messier and reveals some fascinating truths about risk and reward.
To really get our heads around this, let's start with a simple picture. Imagine a company that only does business in its home country. It's like it's swimming in a small, isolated pond. And that pond, well, that's its domestic capital market. The edges of that pond are basically walls. They represent what financiers call a segmented market. It's illiquid, which is just a fancy way of saying there isn't a deep, ready pool of cash to draw from. So raising money is slow, it's clunky, and it's expensive. You're pretty much cut off from the massive global pool of investors. This was the exact problem a Danish company called Novo Industrial faced. They were a huge fish, but they were stuck in that small Danish pond. They realized that for real growth, they had to break out and jump into the vast ocean of international capital.
Now, the main scorecard for success here is a metric called the weighted average cost of capital, or WACC for short. The easiest way to think about WACC is that it's the company's price of money. Just like you'd shop around for the best mortgage rate, a company is constantly trying to find the cheapest way to fund everything it does. A lower WACC is a huge competitive edge. It means more profit, plain and simple.
So what goes into this price of money? It's basically a blend of two main ingredients. First, you've got the cost of equity. That's the return that shareholders demand for taking the risk of putting their cash into your company. And second, you have the cost of debt. That's just the interest you pay on your loans. The name of the game is to find that perfect, magical mix of the two to get your WACC as low as humanly possible.
And to lower that cost, you have to lower the perception of risk. Now, risk really comes in two flavors. You've got unsystematic risk, which is unique to a single company. Think a product recall or a factory fire. It's bad for sure, but you can diversify it away. On the other hand, you have systematic risk. This is the big stuff that hits the whole market, like a global recession. You can't hide from it. And here's the crucial part. Investors only really pay you a premium for taking on the risks you can't get rid of.
And this is where going global becomes a superpower. By getting investors from all over the world, a company basically crushes that unique, unsystematic risk. You see, financial theory, like the International Capital Asset Pricing Model, shows us that when you measure a company's risk against the entire global market, instead of just its little home market, it suddenly looks a whole lot more stable. This lowers its risk score, what they call its beta, and a lower beta means a lower price for its money. It's a game changer.
So there's a pretty standard playbook for how a company escapes that domestic pond. They usually start at home, raising money locally. Then they'll dip a toe in the water by issuing some international bonds. The next step is often to cross-list their shares on big foreign stock exchanges. And finally, they might launch a full-blown global equity offering to really become a household name for investors everywhere.
To do all this, companies have a pretty powerful toolkit. For raising equity, for instance, they can use things like American Depository Receipts, or ADRs, which basically let foreign stocks trade super easily on U.S. markets. And for raising debt, they can tap into massive, flexible pools of international money by issuing things like Eurobonds or getting Euro credit loans.
So when you put it all together, the theory seems crystal clear. A multinational enterprise, an M&E, that breaks out of its home market and uses this awesome global toolkit should get access to cheaper, more plentiful capital. They should win every single time.
But what actually happens when that perfect, clean theory collides with the messy, unpredictable real world? Does that advantage actually stick? And here's the twist, the real shocker. Studies often show that, against all expectations, multinationals frequently have a higher cost of capital than their domestic-only rivals. How is that possible? Well, it turns out that big global ocean they jumped into is full of new, bigger monsters. You've got foreign exchange risk, where a sudden currency swing can vaporize your profits overnight. You've got political risk, where a new government halfway around the world can just change all the rules on you. And then there's just the sheer, mind-boggling complexity and cost of running a sprawling global empire.
So this really brings us to the core lesson here. Just having access to global capital, that's not the prize. The real challenge, and where the true competitive advantage comes from, is in actually mastering the crazy risks that come along for the ride.
So how do the smartest global companies solve this paradox? Well, it all comes down to having a strategic master plan. They have to connect the theoretical why of going global with the very practical how of managing all the dangers that come with it. So the winning formula really looks like this. The why is clear. You're chasing that lower cost of capital that theory promises. The how is using that global funding toolkit we talked about. But the secret sauce, the real strategy, is in aggressively managing those new global risks. We're talking about using financial tools like currency hedging and getting political risk insurance. The best MNEs don't just unlock the door to global finance, they become master navigators of the storm that's waiting on the other side.
Which kind of leaves us with one final thought to chew on. In a world with all these global risks, but also with all these powerful tools to manage them, is staying put in that small, segmented domestic pond and giving up the chance to even compete on the world stage actually the biggest gamble a company can take? Something to think about.